We had the retest of the November low on March 9th and March 10th. And right now, that was a significant low, and that we've bounced off of that. And wouldn't be surprising right now, given the overbought status of the markets, to see some kind of move back down. But I don't really think we're going to go back and retest the retest, so to speak. I think we're in the middle, we're toward the end of a bottoming process, and hopefully we just saw what will end up being the low for the bear market.
A lot of people talking about the anxiety about the upcoming reporting season or the earnings season. Interestingly, you had Alcoa come out reporting a wider than expected loss, but the shares were up today. What does that tell you about the expectations for this earnings season?
Yes, the best thing a market can do is go up on bad news. So here we have it with Alcoa, in which is certainly a widely followed firm, and also one that you can read worldwide implications into its results and its outlook. And what we know is that really Alcoa is doing a bottoming process of its own. And regardless of the fact that the news has been terrible, the stock has gone up. It's a great sign in the intermediate to longer term. And the short term will just take it, because it's continuing a trend here recently where we're getting slightly better news, or when the news isn't so good, the market responds favorably.
How much did the Fed, though, throw a little bit of a spanner in the works on that aspect today? Because the last couple of weeks we've been rallying on hopes that the economy was turning around. We were getting glimmers of hope in the economic numbers. And then you get the Fed come out with the minutes today showing that they've really downgraded their expectations. They're very downbeat.
Well, yes, but the good news is that while they're doing that, they're also putting all kinds of programs into work to try to ameliorate that problem. So, for example, all of the various financings that they're doing is really intended to, again, we've talked about this before, manipulate the supply and demand for securities in the market. And really what it's doing is substituting public credit for what was private credit that is no longer available. And really, that is what they need to do in order to stop a vicious cycle, which they referred to in their minutes, in which the negative effects of the banking system become negative effects for the economy, which then becomes a negative effect for the banking system. They're really trying to put an end to that, and that I think is something that's prudent.
Peter, talk to us as well about this TARP money that we're hearing is now going to the insurance companies. From a confidence point of view, is the market going to be worried about yet another sector needing to be bailed out by the government, and especially considering the debacle that we've seen with, say, AIG?
Well, I think that, this is now a later version of TARP, and we've already seen it applied now. Let's compare it to back in September, October, November, when the program was first created. No one really knew what it would do, what effect it would have, what institutions it would be applied to. As we get a little bit more picture of what's going on, the uncertainty is reduced. And as a result, probably it's a net positive in the sense that we now know that there are a number of financial institutions that they too have received financial backing. And let's hope that it doesn't take very long for them to pay it back. But what it does is it sort of applies the too big to fail doctrine into the insurance companies in our country. And, that will help confidence rather than hurt it.
I mean, which industry isn't too big to fail? It seems like everyone is too big to fail.
Well, that's right. I mean, I think the problem is the Fed is doing the best it can with a really bad hand, and we're in circumstances that are really unprecedented. They're trying, as a result, many unprecedented things. And the hope is that they withdraw the stimulative effects of their policies over time as the economy begins to recover. And I would expect that they are on top of the inflationary expectations that they're creating by all of this as much as anyone else is. And while there are a lot of new programs, they're aimed at avoiding a very vicious cycle that could otherwise transpire.
Are you worried about, people bring up the issue of, but where's the exit plan from all this? Everyone needs a bailout. Everyone's too big to fail. How do we get out of it? Are you getting any sort of clarity on that front, or where do you take some confidence that we can come out the other side?
Yeah, right. Well, some parts of those comments have to do with the ideology of whether someone wants those things to happen, rather than what I try to look at it as an investor. Those are the rules of the game, and what am I going to do about it? In the short run, it has a positive effect of increasing confidence. In the longer run, it could have many negative unintended consequences, but those really are not being able to be seen at the moment, and I have to deal with the world the way it is. So in general, I would look at it as a positive that they are attempting to stabilize the financial system, keep the headline risk out of there about large banks or other financial institutions going bust, which then sets off another cycle of panic. We just don't really want to see that right now.
Peter, just as an aside as well, we haven't talked much about, with anyone, the stress test of the banks. I mean, this is coming up. How key is this for the markets?
Well, that's going to be interesting to watch how people react to that because, you know, banks are doing their own stress tests every day in their risk management reports. So it's hard for me to understand how a government stress test is going to do much better. I'm not saying that the bank stress test and risk management was the greatest, but I don't really know that there's a magic bullet that the government has either that can help them assist that. I think the big thing is that probably more important than the stress test results are going to be the earnings coming up from the banks. Next week, we're going to hear a lot about that, and the banks have told us that they were profitable in February and January. They said March was so-so, and now that it's off the table that they're going to take more bad marks on the assets on their balance sheet, it's possible that they could actually surprise to the upside. That could be a very, very big confidence booster in the sense that banks have really been the results have been far more negative than expected over the past year and a half, and this could be a turning point in that sense.